That was what stopped our class on Wednesday. So we couldn't meet on Wednesday because of the rain. I got stuck in traffic. And even till now, the cold is still getting to me a little bit, but it's all good. It's just that things must be achieved. That's why we are here today, right? Okay, I think I've shared all the links that I need to share. The last thing that I need to do is share my screen. Let's see, total number of 58 persons are in this class. It's a weekday, so it's expected. It's expected that not everybody will have the chance to join us, but then the train keeps moving. So I've checked properly. I just have 3 topics to finish. My only concern is the number of classes that is needed to finish one topic. Okay, so we just have 3 topics, then we start solving all the questions, everything I can solve it. So I believe this was where I stopped. Index futures, have we looked at that? Okay, yeah, the theoretical price. Index futures, asset allocation, cross hedging and related portfolio, we've done this. Currency contracts and forward, I believe this is where we are. This is where we are, and this is where we start our class this night. We're already 15 minutes late. Another lecturer took part of my time. So that was why I didn't start 9 o'clock. Exactly. Somebody was using our time, but now we are ready. So let's kick off. So I hope everyone is with me. Just unmute your mic. I want to start now. Everybody is with me, right? Okay, fine. That's fine. You don't need to unmute it. It's fine. Okay. So now we have been looking at a lot of things and how they say, but and how to hedge and all that with stocks, with financial instruments. But I can mainly focus on interest and exchange rate risk, right? And I told you that by the time we are done with our class, everything about hedging, we will know it. So I believe now that even if they throw hedging of financial instruments or assets to us, we know what to do, we know what they are asking. But now we are now going to the peculiarities of interest rates, exchange rates. We'll see how to hedge them. So after we finish with these futures, we do swaps, right? If we do swaps, we have touched all the tools that are used for hedging. Then we will now do the last topic, which is when we finish futures, we do swaps. We'll do the last topic, which is option pricing. That is, and I know we've already talked about option pricing. We did the put call parity and all, but we are now going to look at it at a slightly advanced level, where we will now be looking at the probabilities involved in option pricing, and then we'll also look at the Black and Scholes option pricing model. If we finish that, if we have time, we'll go into international investment appraisal. Then after that, we are done with this class. So my target is option pricing minimum, at the minimum. Sufficient time will go into international investment appraisal. So let's look at the currency contract. So when you are looking at currency contract, now we are looking at how we use futures or forward contracts to hedge risk that involve exchange rates and interest rates, right? We are looking at exchange rates and interest rates, how to manage those risks. Do we agree that there could be risk arising from exchange rate and interest rates? Do we agree? You can give me a thumbs up. Yes, Grace. Grace. So Grace, you are the first person to give me a thumbs up. Unmute yourself and tell me, how do you think we can hedge risk that involve exchange rate and this thing? Grace, there is a lady, Grace. Yeah, I know I'm doing something lately where I will say, give me a thumbs up. Then the first person I will just say, oh yeah, you answer. That doesn't mean you people won't be giving me thumbs up again. No. But Grace, answer. Okay, anybody, just tell me, what could be the problem? What could be the problem with exchange rate and interest rate? What are the risks involved with exchange rate and interest rate? You
When
are
there is
laughing. When I say thumbs
fluctuation,
up now, you
Loss.
can I go?
yes?
Yeah,
All right.
the
Go on, go on.
When there is
One
fluctuation
person
in
at a time, please.
when there is fluctuation in exchange rate, it's actually going to affect the interest to be paid. Perhaps if we take a foreign loan, the borrower tends to pay higher amounts of interest. However, when it's a downward, when there's a when the foreign currency actually depreciated as well, then the interest rate will be paid will be lower and vice versa. So interest rate and exchange rate goes. There's an inverse relationship between the two.
Hmm. Sorry, I can't see your name. Oh. I don't know. There are people want. Just hold on. Oh,
Abodun
don't go yet. Let me see something. What's your name, sir?
Abodun Ismail.
I don't know why I can't. Omodurin.
Abodun.
Okay. Abodurin. Oh, Abodurin. You shouldn't be in this class. Oh, you know why?
Why is that?
You shouldn't be in this class. You have gone past our level. In fact, you should be the lecturer. I
Well, I
wasn't
don't
expecting that explanation, sir. You did very well. It's a compliment, actually. You did very well. I'm glad you gave that explanation, right? It just in nutshell summarizes what we are going to be looking at, right? So we are going to be looking at how these exchange rates and interest rates affect each other. Admit. So let me admit people. How they affect traders, how they affect transactions, why people would consider interest rates when they want to hedge, or why they will consider exchange rate when they want to hedge. Much later, we'll also look at the types of exchange rate exposures. That is economic risk, translation risk, all those kind of things. We'll explain them. So you just know these things, right? For in case it comes out in theory. So, but thank you very much for that explanation about it. You did well. So basically what he has said is what we are looking at here, right? The way the movement fluctuations in interest rate and exchange rate. We know that these things change, especially exchange rate, right? Exchange rate is quite volatile. Interest rates also change, but exchange rate is quite volatile, right? It changes a lot. So if you want to buy something today, if you are planning, you have 100,000 naira to buy something, and let's say you can only buy that thing. What's today's date? 26th of September. You can only buy that thing in November. Let's assume the whatever you want to buy is going to be affected by international trade, right? Maybe somebody is bringing it in or whatever. So you know that between now and that time, the price might change as a result of exchange rate. We are all in Nigeria. Why am I even explaining this? We are all experiencing this. But recently, exchange rate is falling. Oh. Somebody is talking. Or why am I echoing? I don't have. It's only one device I'm using. It's only one device I'm using. Oh. Why am I echoing?
Oluwatos.
These guys are funny. So we're all in Nigeria, right? We understand the peculiarity of our economy, that we are very sensitive to any change on the upward side. So I think over the last 1 week, exchange rate has fallen up to like 1,400 naira. We did not see the price of things dropping in Nigeria, right? Things still remain the way they are, or even in some instances, still they are still increasing. But let our exchange rate increase from this 1,400 to 1,550 in the next 2 days. The things that are not even that is not even affected by exchange rates, you see everybody. Pure water seller, you know, you say dollar don't increase. Biscuit seller, everybody wants to increase it because of exchange rates. But if it drops, we don't see that kind of impact in the economy. So sometimes it just we need to take a very important call. A minute, please. Hello, guys. I'm back. Sorry about that. Okay. Can you hear me? Please confirm if you can hear me. Hello.
Yes,
Okay.
I can.
So So the exchange rate differences is something that affects everybody. It affects the common man. It affects the biggest of them all. You can imagine, right? So that's just it. So we are going to discuss the peculiarities with this exchange rate and interest rate, and how they affect the market, and how people use derivative contracts like futures and forward rate agreement and all those kind of things, euro dollar futures. Price changing as at the time you want to buy it. That's what will finish this class. So down to business. Currency contracts like currency contract law protect is hedge against the risk of exchange rates, right? There are agreements to buy or sell currency at a fixed. Sorry, let me zoom this out for our YouTube guys, right? I hope this is good enough for them. There are agreements to buy or sell a currency at fixed exchange rate. I stopped here. I want to tell
Can anyone hear him?
No, no, no. It's the network. Abubakar, your video is on.
hello guys, can you hear me?
No, but
Hello,
we can
can you
hear
hear
you
me?
now.
Sorry,
Yes.
this my network has started again. Oh God.
Holy Ghost fire.
I beg. Since morning it's been good. Oh. God have mercy. What's happening with this network again? Just trying to know what's going on. Ah, God. Can you just stay at the place? Okay. Are we good now? Can you hear me?
Yes, sir.
Okay. I beg. Network, please. So currency goes up and down in value, and for businesses or investors dealing in foreign currencies,
Your screen
this
is not
creates
showing, sir.
exchange. My screen is not showing.
No, sir.
Ouch.
Yes, it's not showing.
What about now?
It's showing, sir.
Yes, it's showing now.
Okay. Okay. We'll finish this class today. Currency. Okay, so now we are going to look we've been dealing with forward contracts, right? We've been looking at forward, we've been looking at futures. So now we are going to look at currency prepaid forward. Prepaid forward. So when we talk about prepaid forward contracts, right? We are looking at contracts. Normally, who can give me, somebody just give me, or we don't have time. Let me skip that question. It's not too important. We are looking at situations where you go into a forward contract, right? And then you pay some money to receive another money in the future. So we know how this thing works, right? You know how this thing works. When you want to buy another currency, let's say USD, you pay Naira, you receive dollar, right? Now, when you are using a prepaid forward, that's why it is called a prepaid. You are going to pay Naira today, and then you will receive dollar in the future. That's how prepaid forward contract works. We know that in normal forward contracts, you do not pay anything. You just agree whatever the price, you agree it today, but it is going to be exercised in the future. But with prepaid forward contracts, you pay the money today, and then you receive the other currency in the future. We understand this, right? Now, interest rate is important in prepaid forward contracts. Why is interest rate important? We know that as finance professionals, the concept of time value of money is something that follows us up and down like our shadow. It cannot leave us alone. As a finance professional, if you are not thinking about the time value of money, then you have not started. It always has to follow you. So why am I saying that? I'm simply saying that because when you are looking at the situation where you have to pay money today and receive the other one in the future, we know that if we are buying dollar from the market, right? If we are buying dollar from the market and we pay 1,000. How much is exchange rate today? Anybody? I think it's around
1478 official rate.
1478, right? Okay,
Yeah.
so let's use that. Assuming we pay 1,478 naira today, and we get $1 today, we know that we can take that $1 to go and do a business. Let's assume that a forward contract is agreed. Today is 26th. A forward contract is agreed to be exercised on the 29th of this month, right? Well, you know that within this 26th and 29th, you would have taken that $1 that you bought and you take it to a market or maybe an investment, and you invest it and you earn interest rate on it. Now, where does interest rate come into this prepaid forward contract? If you pay $1 today, if you pay 1,789, right? That's the rate you called, whatever it is. 1,789, you pay it today, and you are receiving that interest and that dollar on the 29th. It means that there is money you should have earned, which you have done what? Let go of. Am I speaking to someone? Do you guys understand?
Please, I take it
Somebody,
again.
Please take it again, sir.
I'm
No,
I'm
sir.
saying
Yes, come again, sir.
I started from the concept of time value of money. Who can tell me what the time value of money concept is saying? Who can tell me? Let's start from there. Someone. People wants to join this call. Okay. Let me see if I can add them. Yes, I'm waiting. Who can tell me what the concept of time value? If you will not tell me, I will end the class and we'll call it a day. Because I don't think there's any SFN student that doesn't know that. Just tell me the basics. The basics. You don't need to explain too much. Just the basics. What is the idea behind the time value of money?
When you talk of time value of money, we are talking
Okay,
about
should I?
Yes,
time
I'm listening.
value of money. We are talking
Okay, should
about
I?
value of money. We are talking
Eh?
about. Can you hear me?
I can hear you. Go ahead.
Okay, when we talk about time value of money, we are talking about the impact of the current cash in future date, which can be impacted either by inflation or some
Okay.
other factors.
Thank you. Thank you. You are right. However, but
Can I try, sir?
I'm looking for a phrase. Some phrase that
Let,
just guides
let
this
me try,
principle.
sir.
Yes, try it.
Time value, just like a simple explanation. 20,000 naira now and 20,000 naira in the next 1 week won't be of the same value, sir.
Exactly. So which one is better according to that concept?
20 naira today.
Now,
Now,
Yes. So the concept of time value is saying that money now is better than money in the future.
For
The
sure. It
idea,
has what now? Yeah, it has more
yes,
value
the
now.
idea, the idea behind that is that there are different ways you can interpret it. But the
I have a
idea
question.
behind that is that, are you saying you have a question?
Yeah, like the contradiction. Yeah, like the contradiction to that.
Go ahead.
So it depends because sometimes if the economic keeps on getting better, the value of the money now can actually be better in the future.
No, your contradiction is way off. You are not coming from where we are not on track
Yes,
together.
sir.
You get, we are not on track together. Now, what we are saying is money that you have at hand is better than money that you will receive in the future. If you want to look at it from the layman perspective, it makes sense. But let's look at it from the financial perspective. There's an adage that say a bird in hand is better than two in the forest. Abi?
yeah, yes, yes.
Yes, that
Sir.
is a basic way to explain it. What you have at hand is better than two in the forest. Now, the idea when it comes to finance is that the money you have right now, you can use it to invest. The money you have now, you can invest it or do something with it and earn money on it. We know that other factors can affect it and it can go either way. But they are saying that all things held constant. I'm an economist graduate, right? So there's this sentence we use, ceteris paribus. Anybody who is an economist here will know. So all things held constant, a money that you have in your hand now, you invest it. It can earn you returns, be it in the form of interest or revenue or something. It can earn you returns. But the money that you are expecting in the future cannot earn you returns because you cannot invest it now. So let's just assume that your brother promised you money, that he will give you 20,000 naira in December, and then your daddy now that gift you 2,000 naira today. If you are prudent in your investment, do you know that 2,000 naira can be 40,000 naira? I'm not saying it in a realistic sense now, But I'm just trying to let you know that you can use your money and earn something that it will be worth more than what you are expecting. That is the concept we are bringing into this prepaid forward contract. So what they are saying is that why we are bringing interest now, we are saying we pay money today. I think I've explained this basic. We are going to pay money today. This is how the prepaid forward contract works. Well, we want to receive $10,000 in the future. What is that future? Let me not go too far. Let's take the future to 4 days from today. That is 30th of September, right? We are going to receive $10,000 on the 30th of September. We now go into a prepaid forward contract. Now, the idea is that as at 30th of September, you know that because dollar is the constant factor in this transaction and your naira is the variable. So it means that naira can change due to exchange rate. The exchange rate somebody mentioned for me, I don't know, can't remember the exact value, but you mentioned 1,740 something naira, right? 1,740 something 1,735 naira. Let's just leave it at that. Now, between now and 30th of September, that money can increase to, let's say, 1,900, or it can increase, or it can reduce to 1,300. The $10,000 that you are expecting on the 30th of September will not change, but your variable currency, which is the naira, can either increase or decrease based on the exchange rate value. Do we have this idea first? Answer me.
Yes, sir.
Good. So I've succeeded
Yes, I
in
do.
explaining things. Number one, the time value of money, and number two, the movement in exchange rate. Now you must receive $10,000, but your exchange rate can either make you pay more naira or less naira. Now, you have already budgeted that for this $10,000 that I want to receive, I'm going to pay how much? Let's say 13 million. That is what you have budgeted. Whether exchange rate wants to follow, whether exchange rate wants to increase, it's none of your business. You just have 13 million that you want to pay to receive that $10,000. What will you do? You will now go into in the case of this prepaid forward contract, you will now pay that 13 million today. You agree that the exchange rate based on 13 million to $10,000 is so amount. That is the amount you are going to, that's the exchange rate that you people have agreed. So whether exchange rate goes up or goes down, it doesn't affect it. So you are going to get that $10,000 on the 30th of September. Now the prepaid forward is now saying, assuming today that you pay that 13 million, you receive $10,000 today. Within today and 30th of September, you would have used that $10,000. The time value of money concept is coming in now, right? Don't confuse it. I'm just using this time value of money concept to make you understand this thing better. But if you are reading the text the way it is, you will not see time value of money there, right? I'm just using it because it's the most basic way to make you understand it, right? So this concept is now telling you that if you receive this 10,000 naira today, being 26th of September, within today and 30th of October of September, you can use that 10,000 naira, $10,000 to do something that will earn you sufficient return, and that is where the interest rate is now coming in. So the interest is representing the return that would have accrued on that $10,000. Am I making sense now? Nobody is answering me. Oh.
Yes,
Yes,
yes.
you're
Continue, sir.
Yes.
You people are now afraid to give me thumbs up. Kai. I've done bad. Okay, I will change it from the first person to the last person. The last person that give me thumbs up now will answer question. Okay, so the concept there is now saying that because of this possibility of return that you could have earned, we have to take into cognizance the interest rates that could that the prevailing interest rates as at that period. So that is what is now bringing us to this formula that we have here, where we have the forward, this FP here is the forward price. O is talking about current, right? T is the time agreed, right? So the current forward price or the prepaid forward price is equal to your spot rate. We know what spot rate is, right? Spot rate at times 0, that's your current rate, times your Euler's formula, your Euler's number, raised to RO is your risk-free rate, which is the interest rate that we are talking about. This ROI is the interest rate of the country, right? The foreign interest rate, and T is the time. So this is how you solve for your prepaid forward contract. So if you are in the exam situation, you have to understand if they are saying you are paying the money now, and it is a forward contract related to exchange rate, you have to know that this is what you are bringing in, right? So I will just read these things. I've explained it to you off the material, right? But I'm going to read it from the material now so get the understanding of it better. So a currency prepaid forward is an agreement where you pay today in your domestic currency, like dollar, to receive a certain amount of currency, like yen. Okay, so in this material, we use dollar and yen in the future. For example, if you want to receive 1 yen in 1 year, a prepaid forward lets you pay for it now. You pay for it now, which is this 0, right? I'm sure you guys have done. That reminds me, have you guys done bond yield, the yield curve and yield curve and yield curve and yield to maturity? Have you guys done it? That is related to bond valuation. Have you guys done it in your SFM? Somebody is giving a thumbs down. That is a no, right?
We have not
Is
done
that
it,
a
sir.
no?
We have not done
You've
it,
not
sir.
done it.
We have not
Okay.
done it.
Because there were things I was thinking of bringing into this lecture, and my mind was like, have they done this? If I just start teaching this thing, it might. So it has to do with bond valuation, your par value, and all those kind of things. It's not difficult, right? To determine the value of a bond, determine the market value of a bond, and all those kind of things. It's not difficult. It's something I could do, but I don't have the time. Let's see. Maybe I can include it. I said we only have three topics left, but it is important since we are now going, bonds, anything that relates to, because in your exam, when they start asking you about interest rate risk and all that, when they start asking you about interest rate risk and all that, this is bond. They will bring bonds in. So you need to have a good understanding of bonds. You get, they will bring bonds in. So you need to have a good understanding how to value the bond, how to determine if you will buy the bond from one country and invest, trading strategies that you could hedge risk based on the value of a bond, all those kind of things. You get, I'll see how we go about it, Sha. But then let me not deviate too much. So I think that's part of it's part of your SFM material. If you've not done it now, you will do it sooner. Just excuse me for a minute. Let me confirm that it's part of your material. Let me confirm SFM. Let me see the 2025 SFM. It should be part of your syllabus.
Bond is no longer part of our syllabus.
It should be, see now, 27, duration and yield curves. It is now. It is. All these things, you need to determine the yield to maturing, Macaulay duration, and all those things. Yes, it's not in the form of bond valuation. I think they've taken that one to the other one, right? In skills. What was it called? The foundation of SFM that they provided now. But you still need it. You still need the knowledge. You still need the knowledge. You see now, this is okay. This is duration, yield curve. You see all these things here. This is market value of bond now. So you still need to know how to value your bond. You see, and I believe they will still be. So don't just go and sit down and say bond is no longer part of your syllabus. So if it's here, then it's part of your syllabus. You get. So as much as you can, try to read up. We'll do our best to give you everything, but on your own to try to read up. If I had not shown you this now, you just cross your leg and say it's no longer part of our syllabus. See it's here. Abi, everybody can see it now. Abi, chapter 27. So they will not put it as bond valuation. You have duration and yield curve. When you see this thing, know that you are looking at bond, right? Okay, that's enough deviation for now. So so this is where I am. The current exchange rate, blah blah blah. So if you want to receive one yen in 1 year, a prepaid forward lets you pay for it now and get the yen later. The price you pay today depends on the current exchange rate, right? And the interest rate of the foreign currency. For yen, this will be yen interest rate. Why is the interest rate important? If you had 1 yen today, you could invest it and earn interest for 1 year. This is what I was explaining. But with a prepaid forward, you get the yen later. So you cannot invest it. You have paid money, you are not receiving value for the money that you've paid immediately. So you cannot invest it, right? So you miss out on that interest. To reflect this loss, the prepaid forward price is discounted. So this is what they are saying. You pay less than today's exchange rate. So to compensate you for that money that you are losing, the prepaid forward price is discounted and you pay less than what you should have actually paid, right? It's like buying it at a slightly lower price because you are not getting it until the future. This is just like a prepaid forward price for stocks. We did the prepaid forward for stocks and dividends, right? The price is lower because you are missing out on the income during the waiting period. Thus, the prepaid forward price for a yen is the. I know that I've taught you this before. I think under forward contracts, where we did the prepaid forward contracts and all that, I taught you this something similar, but then it was compensation for dividends, right? In that case, maybe you are paying. If you had bought the stock now, if you had received the stock now, you will be earning dividend on it. But because you will not earn dividend on it, you are compensated for that. So whenever you have prepaid, whether it is based on interest rate, exchange rate, or stocks, there is always a compensation because you are not getting value immediately, right? So I know we've done this before. Please read up. The material is with you. You have your icon study pack. You can still study. So this is what the formula is, where T is time to maturity, spot rate. This is our Euler's number, the foreign interest rate, and the forward prepaid forward price is equal to this. So example. So let's look at this example. Say you want 1 yen in 1 year, and the current exchange rate is $0.009 per yen. If interest rate in Japan is 2%, what do you need to pay today to receive 1 yen in 1 year. So you just apply this into this formula, right? So this is our computation. So you press this and you get this value. So somebody just punch this quickly for me. I know you guys are there with your computer. Sorry, with your calculator. So somebody punch it and let's be sure that this is the answer that we got. Right? Okay, so Olayinka David is giving me a thumbs up. So that means we are fine, right? So you pay 0.008 as your futures and forward price, right? Your forward rate, rather. That's the forward rate you agree today to receive 1 yen in 1 year time. So now let's look at currency forward. A currency forward is different. Now this one is a prepaid forward, right? So this one is different because in this case, we are not paying anything today. You get, you are not paying anything today. So you just agree, just like the normal forward contract, right? A currency forward, you agree today to exchange currency in the future at a rate that's fixed now. All these people that wants to join this call. Admit all. They never get finished. You guys leave and come back, you leave and come back, you leave and come back. You see, I just admit. New person is coming up again. Okay. So a currency forward is different. You agree today to exchange currencies in the future at a rate that's fixed now, but you pay later. It's like making a reservation for a future exchange rate. You don't pay anything today. Payment happens at the end of the contract. So the pricing logic, the forward
Sorry,
price
sir.
is
Come see your screen.
You can't see my screen. You can't see my screen.
It's
Does
our
this
network.
apply to everybody?
No, we can
It's
see
a
it. It's our
network, right?
network. Yes.
Probably We your can see your screen.
Okay, there's only always that one person that their network is making us ask this question in all the class. You people will start paying fine now. It's all right. Okay, so the forward price is based on today's exchange rate and the interest rates in the different interest rate difference between the two countries, right? So now, if the domestic exchange interest rate, e.g. the USD, is higher than the foreign exchange rate, the forward rate will be higher than today's spot rate. This makes sense because if dollars earn more interest rate than yen, then yen becomes more expensive in the future. To obtain the forward price, compute the future value using the forward dollar denominated interest rate, which is R. So this is how you compute the forward rate when it is not prepaid. That means you are just agreeing the rates in the future. This is the formula. Is there anything that is confusing about these two? The prepaid forward rate and the currency forward. Is there anything that is confusing about them? So if you look at the formula, the only difference here is that here you have the domestic interest rate and you have the foreign interest rate. So you do the difference between the two. In this one, we just brought in only the foreign interest rate, right? But in this case, we do both the difference between the domestic and the foreign interest rates, and then we get the forward rate. So if you use the same example, now we have the yen, which is the foreign currency. We have the interest rate as 2%. The dollar, which is the domestic interest and domestic, what was it called? Domestic interest rate as 6. So what will you do? And you have the exchange rate at the spot rate at 0.09. The spot rate is the current exchange rate between the two currencies. So you have 0.06 minus 0.09 2, which is the foreign, right? Apply it to your Euler's number and then multiply it by the current spot rate, you have this value. So this is the forward and the forward or future rate you apply in that contract for 1 yen, right? So I believe with this, we have a good understanding how to hedge with forward or forward rates, forward contracts when it comes to exchange rates, right? Is there any question, any confusion, any misunderstanding, or maybe anybody wants to buy exchange and dollar and gift me? If you want to buy dollar and gift me and you're not sure what you use to lock the exchange rate, let's discuss. These guys, they are not, nobody wants to. If you just do thumbs up now, I will tell you, hey, it is you that want to. Oh yeah, Emmanuel, how much do you want to buy for me? Emmanuel, I am open. No. Okay, no problem. So you know how to hedge. That's good. So this is when you are hedging exchange rates. When you are hedging exchange rates, right? This is how you go about it. So now let's look at covered arbitrage. This one is a bit complex. It's a bit complex. So I'll go down. Let me see. I think I included something. Oh, somebody wants to say something. Okay. So now a covered arbitrage is like covered interest arbitrage. So now you are looking at a situation, maybe you are an investor and you are thinking of the possibility of using of borrowing from one country and investing in another country. So if you are borrowing from one country and you are investing in another country, what are the things you consider as an investor? Sharp answer now. You are borrowing from A and you are investing in B. What are the things you consider as an investor? Guys, now, come on. Just tell me 2 or 3 things.
Tax implication.
That one is there.
Cambridge.
You consider
Tax
what?
implication.
Yes, that's valid.
Exchange rate.
Exchange rate.
Good.
Inflation.
You will consider exchange rate. You will consider so anything that involves cross-border transaction or cross-border interest. One of the first, cross-border trade or business. One of the first things that should come to your mind, in fact, not one, the first thing that should be on top of your mind is exchange rate before you will now start looking at other things. You understand? As a businessman, you are buying from abroad and selling in Nigeria, exchange rate is affecting you. Maybe you are doing service, you are giving service to this. I know a lot of people sit at home and work for business companies in the US and this. Exchange rate is also affecting you. The day that they employed you, exchange rate was 1,000. How much? 1,000. 1,500, right? Let's say things get better and then at some point in time, exchange rate dropped to 200. You know that the day that they employed you till now, your exchange, your this thing, your salary would have dropped, right? But if we look at the economic implication, your life might have gotten better because there's what they call the purchasing power parity. So when I see a lot of people, if I'm checking online and people just discuss things and they only base their discussion on the exchange rate value when they are comparing countries' benefits and all that. Exchange rate, yes, is valid, but it's not the only valid part. You need to consider the purchasing power parity. The purchasing power parity is simply telling you like what $1 can buy in so country and what it can buy in your own country. So yes, the exchange rate might be moving, but it is the purchasing power parity that gives you the good perspective of how rich or how poor one country is compared to another, because now it is not looking at the actual value of what somebody can buy living in the in country A and what somebody can buy living in country B. You understand? That one is talk for another day. Hopefully we have the time. You get? So all these things are things you need to consider, but exchange rate is very important when it comes to cross-border transactions. Then you also need to consider interest rates. It is also very important, right? This is one of the reasons why interest rate is important. We have also explained it. Some of you mentioned inflation. Yes, inflation is important too. Somebody mentioned taxation. Yes, taxation is important too, because you also pay taxes, right? Import duties, excise duties, all those kind of things, tariffs and all those kind of things. You pay it when it comes to cross-border transactions. So it's fine. You guys are correct, but exchange rate is very important. I think as a business person, is the first thing that should come to your mind. So let's look at the covered interest arbitrage, right? So when you talk about covered interest arbitrage, this one involves people that are looking for business opportunities out there. So you are looking for investment opportunities beyond your country. So you can be looking at, okay, if the interest rate in my country is not attractive enough, or if something is not attractive enough, or maybe one of your guy now in Czech Republic calls you that, oh bro, there's this investment opportunity in my country and this and that and that and that, and would you like to take it up? You don't have the money, so you need to borrow money from your country and invest in that country. That's what the covered interest arbitrage you need to look at, right? That's where it comes in, how you can use this to hedge your position, right? Or see if there is how you need to use this to determine a forward or a futures price that you can use to go into that contract, so that you will not lose too much. These things are sweet, you understand? You see this formula, if you are able to get it, you can tell you that, okay, this is the price that you can determine, this is the forward price that you can use, considering the exchange rate and this thing, considering the interest rate in the domestic country and the forward foreign country, right? You use this formula. This is the formula. I'm showing you this formula so that you can use it in exam, but that's not what we use to solve this here, and I will explain why, right? So let's continue. Covered interest arbitrage is a strategy that uses borrowing in one currency, then investing in another using a forward contract to hedge exchange rate risk. This strategy ensures a risk-free profit if there is a difference between actual forward rates and those implied by interest rate differences. So let's look at it for an example. So I've explained this. So in a nutshell, before we go into the explanation, the example property, is there anybody that have any question on covered interest arbitrage? Anything that you are not sure of, you want to understand? Question. You have 30 seconds. I'm counting. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times 3, 30. Thank you. Your time is up. Suppose you want to lock in the futures cost of one Japanese yen in terms of US dollars using interest rate and today's exchange rate. You follow these steps, right? One, you borrow USD, borrow only what is needed to end up with 1 yen. So what they are saying is that the strategy for you to determine the futures price that you will need to invest in another country. Number one, you have to borrow. So now we know the example we are using is USD and JPY, right? Now borrow only what is needed. But I know some people, when they say borrow, they want to borrow the whole of Africa. And then you now say you want to hedge it. Meanwhile, maybe you go and borrow 100,000 because you can. You now invest 10,000. And you use 90,000 to Jai, or how do they call it? Do Owambe or something. Enjoy yourself, Sha. Then you now want to use the exposure or the returns from that 10,000 to hedge 100,000. Bros, it no go work. It will not work. You get. The idea is to borrow only what you need. Borrow what you need to hedge that risk. So here we are using 1 yen. But for example, the investment is $10,000. Borrow $10,000. Do the exchange rate. So how many yen will be equivalent to $10,000? So based on current exchange rate, 50,000 yen will be equivalent to $10,000. Borrow 50,000 yen. Do you get the point? Or borrow $10,000 rather. So that is the first step you need to do. The second one is convert the dollars to yen. Now you know you want to go and invest in Japan, right? You borrow $10,000. You cannot take that dollar and invest in yen because dollar is not the currency of Japan, right? So you need to convert that money to to yen. Number one, you borrowed what you need. You are now convert it to what you want, right? Using the current spot rate. Then you now invest that yen. So in the example that we are saying, we say 50,000 yen is equal to $10,000. So at the point of conversion, you have moved your $10,000 to your 50,000 yen. So now you have 50,000 yen, which was what you borrowed in US dollar, right? So at the back of your mind from my explanation, you ought to have known that interest will be accruing on that $10,000 in the domestic country, which in this case is the US dollars, is the USA, right? Am I speaking to somebody? I'm
Yes,
walking
sir.
you guys. I'm walking you guys, right? Because when we go into this computation now, it's supposed to be easy. So I'm just walking you guys one after the other, how you are doing this thing, so that you get the idea. So I don't want to get to the end now and there are too many persons telling me they don't understand. It go pain me. So you have the dollar. You are going to invest it in yen, right? You change it to yen. You take it to Japan. You in your currency, in your country, USA. By God's grace, all of us country in USA. In our country, USA, our $10,000 is accruing interest, right? We're expected to also earn interest from the investments in yen. So you put the money into a risk-free investment like a bond to grow to 1 yen after 1 year. Now, there is a tricky part here. There is a tricky part. If you look at this now, you know that yen is the weaker currency, right? Yen is the weaker currency. Now, because yen is the weaker currency, we have the US dollar as the currency with a higher value. Your target is to make 1 yen, right? Your target is to make 1 yen in 1 year. So when you are borrowing, you are going to make sure that what you are borrowing, this first part that they said, what you are borrowing, you are going to borrow in such a way that in US dollar, whatever interest accrues on that US dollar in the time period that you are going to invest, both the amount you borrowed and the interest that will accrue will be equal to what you are going to invest in the future. And what you expect to get from your investment in the future. Am I making sense?
Yes, sir.
For example, you want to borrow, you want to invest, you want to get a return of one, or let me come down to Naira and cedis. Let's leave this example. You want to get 10,000 cedis. Let's forget about which currency is the strongest now. Just follow my example. Assume that I am the president of the two countries. I will determine the exchange rate and everything. Assuming you want to get 10,000 Naira, right? Naira is the stronger currency, and you are borrowing from your country, Ghana. If you borrow from your country, Ghana, you want to make sure that the interest that you are getting, that you are going to accrue on whatever amount you are borrowing from Ghana, plus the amount that you borrow, that is the interest and the principal, both of them join together. At the end of the day, that amount will be equal to the return that you are getting from Nigeria. Don't forget where we are heading to. Where we are heading to is to determine a futures price that will allow us to lock in our exchange rate, so that no matter the fluctuation in interest rates in these two countries, we will not lose. You remember that's the objective. Talk to me.
Yes.
Talk to me, guys.
Sir.
You remember that is the objective, right? Good.
Yes, sir. Yes, sir. We remember.
So that is what we want to achieve. Now we are going to look at how much we can borrow in cedis, so that when interest accrues on that money and the principal that we took, it will be sufficient, or it will be equal to the amount we are going to get from Nigeria based on how much we want to invest in Nigeria. Am I making sense? Only one person, no. Don't worry, I will not ask you a question. Only one person. Am I making sense? Okay, good. So I'm coming back to this place now. The third one say invest the yen, put the yen into a risk-free investment to grow to $1 after 1 year, right? Then repay the dollar loan, that means this is what you borrowed from your country. The amount you repay becomes a synthetic forward rate. Now, you will now get a rate. So if you do all this, to do all this, what do you need? You need your country's interest rate. You need to know how much you want to borrow so that you can calculate how much you are paying back. You need the interest rate on the investment you are doing in the foreign currency. You need to know how much you are investing in that foreign currency so that you know how much you are receiving, right? Then after that, so now you have interest rate of the domestic currency. You also have interest rate of the foreign currency. You have your principal amount, which you borrowed, and you use that to determine the principal amount which you are going to invest. Now, you have all these things. The next thing that you need is your spot rate. Right? You need your spot rate, which is the current exchange rate, right? You need that. So if you have all these ingredients, you are ready to cook your soup, your favorite soup, your exchange rate, your forward rate soup. You are ready to cook it. So that is what we will need for this example, right? So let's say, for example, our current exchange rate is 0.09. Our interest rate in Japan, the foreign currency, is 2%. Our interest rate in the US is 6%. We are now told to do what? To determine our futures rate, that the futures rates that we are going to lock in, so that when we invest, we will be able to hedge our exposure based on this investment. See, I know you are hearing me, and I know that you are understanding me, but I want this thing to sweet you. So if you are is sweeting you, like, that's when I know that you are getting the juice. You understand? Just respond, maybe give me a thumbs up, because that's how I feel. If I'm reading something, or I'm listening to something, and I'm not just understanding it, I'm absorbed. There's a difference between understanding and absorbing. I want you to absorb it. Don't just understand. Absorb it. Let it be a part of you, right? The thumbs up I'm asking for is not praise from you. I don't need it. I don't need anybody to praise me. I'm just trying to ensure that I'm impacting. Right? I'm not that kind of person. You always hear me complain about time, that time is not on my side. But when my class starts, I want to ensure that everybody is coming along. Right? That's why I take my time to explain. I take my time to do the computation. I take my time. So as much as I'm saying, yeah, I'm behind time, I'm behind time and all those kind of things, I'm more interested in you absorbing it, right? So if you are absorbing it, please let me know. Are you guys getting this thing? Are you guys getting it? If you are not, ask me a question now. Okay, good. Okay. So now let's look at how we walk through this. So figure out how much yen to invest. So remember what I told you, right? You need to determine how much you want to invest. So if the yen rates are 2%, then to have 1 yen in 1 year, right? This is what you want to get in 1 year. To have 1 year in 1 year, you only need to invest. So we do the present value. That means we discount 1 year, 1 yen, using our what? Our interest rate, right? So if you do that, you have 0. You have 0. Did I do this thing correctly? I'm thinking I did it I did it upside down. No. Let's go to Excel. This is wrong. It's supposed to be equal to 1.02 divided by 1. It's not correct. It's giving me 1. So this is supposed to be 1 divided by 1.02. So this is how much we need to invest in yen. Sorry guys, please, if you are looking at this, correct it. I don't know, I cannot correct this except on my Word document. So this is supposed to be 1 divided by 1.02, right? That's the present value. Are you with me? So this is what the future, the value in the future that we want to invest and want to get from our investment is $1. So how much we need to invest today to get $1 in the future is 1.02. So we need to invest 1.02. Sorry, we need to invest 1.9802 at 2% interest rates for us to be able to get $1 in the future. Am I making sense? Am I communicating? Okay, good. Then convert that yen to dollar. So you remember what I told you, that when you are borrowing in your domestic country, you need to make sure somebody is speaking. Are you asking a question or distracting us? Are you asking a question or distracting us? Speak up. Okay. So you need to make sure that you are investing 1 yen. You are investing. So how much do you need to borrow in your domestic country? Right? How much do you need to borrow? Let's go back. You see your spot rate here, right? So if you convert this 0.980 that you have here, if you convert it using your spot rate, this is what you have, right? This is what you have, right? So this is this money, this is the value of this money in dollar, right? So if this is the value of this money, this is yen, this is the dollar value given our spot rate as at today, right? So borrow that amount in dollar. You don't have this money currently, but you want to invest it. So you borrow it from your domestic country, which is the USA. And what is your domestic currency interest rate, right? You have the domestic currency interest rate is this, right? So when you borrow it, what you are going to pay will be this value. Now, this is continuous compounding. When you bring your Euler's number into this equation, what we are doing is continuous compounding. The reason why I put this as continuous compounding is because if you apply these values into this formula that is here, you will get a different value. And why will you get that different value? This formula is used when is used for discrete compounding. I even put it here. It's used for discrete compounding. Whenever you see e raised to power something, that is a continuous compounding, right? And the reason why this is important for us to introduce it here, when we start looking at advanced option pricing models like the Black and Scholes pricing models, this will come in a lot, right? This will come in a lot. So if you bring your 2.718 here, you bring it here and you equal it into this, and you do this, right? This is what you will pay in the future. So this is what you borrowed. This is the interest rate compounded into the future. It gives you this, right? So this is what you pay. So this amount here, this 0.0936 is equivalent to 1 yen, given the interest rate of the two countries. It is equivalent to 1 yen, given the interest rates of the two countries. So now they now say you take this money, invest in Japan. Meanwhile, don't forget that when the money you need now is 0.98, right, in Japanese yen at the interest. So if you invest this money, if you invest 0.982, which is what we got here initially, right? If you invest it at 2%, if you increase it by 2% in 1 year time, this times 1.02. So we see this is approximately 1 yen, right? This is approximately 1 yen. That's what they are trying to tell us there. There is approximately 1 yen. So you owe $0.039 and you receive 1 yen. This means the synthetic forward price, your synthetic forward price is this. So in your domestic country, when you are going to hedge based on what you are borrowing, you want to determine the forward price, or sorry, the forward rate rather. This is the rate that you agree in the future. If you lock in this rate and you borrow giving these interest rates for Japan and yen, at the end of the day, you would have made sufficient profits to be able to pay off what you borrowed in your domestic country. Have I succeeded in, how do they put that in convincing you or confusing you? Somebody is crying. Oh. You guys should talk. We don't have much time. Olayinka David, are you confused?
Yes, I am, sir.
All right, tell us where you are confused.
I think I understand the first part, the first step. So I think, to me, I think if you can just take the step and work it out in the Excel sheet, we'll be following more properly. Doing so, like be doing the step by step in an Excel sheet. I think we'll get it more.
Is there any other person that is confused? Who else? We have 37 people in this class, I think. 36. Who else is confused? Nobody else?
I
Because Olayinka is saying,
sir.
yes, what did you say?
Yeah, I'm not very clear. So adding my voice to what he just said, that working it out step by step will
Okay.
help. Thank you.
Okay, let's do that for your sake, for all of your sake. So I wrote the steps here, right? Now I explained something that if you take these values and impute it into this formula, let me just finish this before we enter euro dollar. I'll walk through that again. If you take all these values and impute it into this formula, you will not get the same answer, right? You get a different value. However, what you are getting is the same thing as the futures exchange rate that you will use to determine, to lock your position, right? The reason is because this one we are bringing in the Euler's formula, right? The Euler's number, right? You can see it here. This one we do not apply it. So this ARU US is the domestic exchange rate. ARU JP is the foreign exchange rate. So in your exam, you see something like this. You see questions like this. Apply this formula, right? You apply this formula, this one, the discrete, except it is stated. The reason why I'm bringing this in is that in your materials, or maybe if you look, most textbooks, they only bring in this formula. They don't bring in this. So when they give you a situation where it is continuous compounding, maybe you need to bring in the Euler equation. People don't know it. You understand? People don't know it. So you need to know. That's why I even prefer to work this example using this one, so that you understand it, because it's easier to just look at this one. You know how you just plug in your figures. You have 1 plus your domestic country interest rate divided by foreign country interest rate times your spot value is fine. But if you don't have certain if they mention in the exam that it is continuous compounding, anywhere you see continuous, they might not necessarily put it as continuous compounding, but anywhere you see continuous is a hint that this is what you should use. That's why I prefer this one, right? But you can still on your own go and apply this formula. It will give you a different answer, but you are correct, right? So let's go back to. So I even stated it. If the exact question does not mention compounding, use default to discrete compounding, right? But if it mentions if it mentions compounding, not even continuous, if it mentions compounding, then you apply this step-by-step formula, right? Euro dollar futures. Let me see what we have after euro dollar futures. Interest rate forwards. Okay, we have some examples here. Okay, so let's go back to this. That means we might not have time to do euro dollar futures this night as well. So let's look at this. Now, the example say we have our current, so let me copy this. These are current spot rates. Interest rates in Japan, 2%. Anybody that is sleeping, sleep well. Oh. All those that have gone to sleep, sleep well. It's not easy for anybody. It's not easy for me too. I understand. But if you are writing exam, my dear, you need to stay awake. If you cannot sacrifice few hours of sleep, SFM is not that thing that you write and be sleeping anyhow. If not, when I will pour you water in that sleep. Only we do 9 PG for 2 years. So for all those that usually leave the class very early, please just pay the side. See me, I can sleep anytime I want, because I've done a few number of courses that I want to do. Even till today, I'm still doing courses, but there's a level of relaxation when everything is over and you are at the finish line. So why can't you just sacrifice? I'm seeing this class started with around 50 something, now we are only 35. It's not nice, but then happy sleeping. So tomorrow is even Saturday. So what are you sleeping for? You can wake up by 10 o'clock. I know some of you still attend your normal tuition center, but then it's fine. So then, so let's work it out. You have what was it called? Your current exchange rate, right, is 0.09 per 1 yen, and then your foreign currency, Japan, has interest rate of 2%. So we discount this, right? Because we are bringing it to today's price. So we do the present value, right? So we say this is equal to 1 divided by 1.02. So Olanka, are you getting this? At least you know how we arrived at this value, right? You know how we arrived at this. So what is this value?
Sir.
What is this value, Olanka? What is this value?
We are planning to, like, we're trying to get the yen that we are needed. The yen that is needed today.
Yes, this is the yen that we want to invest today, right? We want to get that yen today. So when we get that yen, the next thing we need to do is to convert it to what? Get yen today. Get yen today. Next thing is convert it to what? To dollar. Convert to dollar. So we have our spot rate, right? Let me remove this. We have this value. So we come here. Oh my God, what have I done? We'll come here. We convert it to dollar. Pakam, it has been converted to dollar, right? So what have we done? We have succeeded in converting this value to dollar. So in other words, we know the amount of dollar in yen value that we have, that we need today. Am I making sense? Right? So this is the dollar that we need today. Now, this is the how much we need today. This is what we need today. The next thing we need to do is to determine based on this amount. So you know that this is what you are going to borrow today, right? This is what you are borrowing today. Borrow today, right? So if you borrow this money today, this is what you want to achieve. You want to achieve 1 yen, right? Yen in the future. So this is what you borrowed today. If you borrow this money and you invest it in your, if you borrow this money, interest is going to accrue on this money, right? So by the time it is 1 year time, how much are you going to pay? So that you pay both the interest plus this principal. So this is your principal. Let me still add the word principal to it. This is your principal in USD, right? So in 1 year time, interest is 6%, right? Interest is 6%. Let me bring that Euler's value, 2.7182, right? 2.71828. Am I correct? Cram it to me. I have many things I'm thinking. I'm not cramming any nonsense formula.
2 points. Okay.
Cram it to. I know I can give a lot of things at the back here, but they will not give you this one, so I doubt.
But it is the exponential figure, right?
Yes. So you get this. So you get this, you come here. What do? You say this, you raise it to the what? To power of, let me see, minus this, 0.06. Oh, sorry, I missed something. This minus 0.2 rather. I put the minus in a different place. Minus 0.02, right? Is that what we have? Or I've gone, where am I? Now, I was the one putting the wrong thing. So this is, the thing did not go out though. Because I did reference this formula and this thing. So wait, let me try something else. Result can be funny. Okay, times, this is what we want, times what? Where are we? Yes, times 0.08, right? That is the domestic money that we borrowed, right? So this times this domestic money that we borrowed. So this is how we arrived at this 0.39, 0.93. So what is this telling us? This 0.93. Are you with me? This 0.93 in our domestic country, domestic currency. Don't forget this is in USD, right? This money 0.93 is simply telling us that if we borrow 0.08, after 1 year, we are going to pay. So this money is equal to principal plus interest. plus interest. We are going to pay this money. No, let me remove the equal to. So this money is equal to your principal and interest. Do you agree with me?
Yes, sir.
Good. This money is equal to your principal and your interest, right? So don't forget that what you needed today is 0.9802, right? So now, if you invested 0.9802 today, if you invested 0.9802 in yen today, let me go back to my Excel and ensure 0.980. Is it 2? Why are we having 3? Get yen to PV. This is yes. This is I think is approximation. It's almost the same thing as approximation. Okay. So if you get this value, this is your USD. This will be equal to 1 yen in future. This will be equal to 1 yen in the future. This is equal to 1 yen in the future. I don't even know how to do it. Let me say equal to, then I come here, 1 yen. Oh my God, I forgot my YouTube people. I forgot my YouTube people. They are always, they complain about, this will be equal to 1 yen in the future, right? So if this will be equal to 1 yen in the future, what does it mean for the investor? It means that if this money is equal to 1 yen, this is what he borrowed from his domestic country, USA, and this will be equal to 1 yen in the future. This is our domestic value, right? So it means that if we are to increase this by 1, we say this is equal to this times 1.02 in the future. So this value and this value, they are equal. They are equal. So what you need to do is that in the US, when you are trading your domestic country, when you are trading your futures contract, you lock the futures, the exchange rate on 0.937, because this is what is equal to 1 yen in that future. So if you take 0.0937, if you look it at that rate, right, by the time you borrow money from your, and by the time you invest in the foreign currency, at the 1 year period when you get return, on the investment, it will be sufficient in the barest minimum. There is no way you will make loss on that investment that you so bad that you will not be able to pay up the loan that you took from your country. You'll be able to pay it up, and you will be able to pay the interest that has accrued on it. Do you get Opeyemi? It's Opeyemi that was asking me, Abi Olainka. So you'll be able to pay up the interest, and you will also be able to pay up the principal, because that's the rate that is equivalent to 1 yen in your foreign currency. So if you do this, it means that you have been able to determine your forward, your covered interest arbitrage. You have been able to determine the forward price or the forward rates that you will use. But don't forget what I told you, that the way I applied it here is because I want to teach you something, the difference between compounding and discrete, right? Continuous compounding and discrete compounding, right? Now, if they mention compounding, normally, if they don't mention anything, use discrete. But if they say compounding or they say continuous compounding, use this one that I'm teaching you now, right? So your forward rate will be equal to your spot rate. Let me do this formula out. Let me put it here. Your forward rate, I don't know even now. Your forward rate will now be equal to your spot rate multiplied by E raised to power what? The rate of your domestic country. So use this formula. I think I did enough to it. So when you have continuous compounding, use this formula. When they do not mention anything about continuous or compounding or anything, use your discrete formula, right? So this is the discrete formula. It's easy to apply. You usually they ask this question. So when we start treating for what's it called? When we start treating what's it called? Past questions, we'll look at this, right? We'll look at these formulas. We'll revisit it because it's very important, right? There's a way you even transpose this, and you also get your using the spot rates. You can using the forward rate. You can also determine your spot rate and all those kind of things. So this euro dollar futures, I don't want to start it and not finish it, right? I think it's the last thing that we need to treat on this topic before we move to interest rate forwards and futures. So I will stop here. I've seen many persons have left the class. You guys can go and sleep. Me too, I'm tired. I know some of us here we work, some of us are just students, some are working, some are still doing ICANN while hoping for a job or something. Whichever case, God bless you. But we need to rest. So we'll see on Sunday. From now till throughout this month, we are going to be having midweek classes. I know some of the lecturers are done or almost done with their subject, right? I pray network and rain does not affect us. I can just come in. Mostly I'm looking at Wednesdays, but depending on how my schedule is, work or any other thing, and I'm having sufficient time, I'll just come in. But I'll give you heads up, maybe 2 hours, 3 hours heads up. I'll come in and we'll have a class. But we need to be having more than one class in a week, right? So that we can cover all this. So have a good weekend. See you on Sunday. Enjoy yourself. For the football fan, I always greet you. If you are not supporting my team, I will not tell you who my team is until after your exam. I do not wish you good luck. Take care of yourself and good night.
Thank you, sir. Thank you, sir. Good night.
Thank you. Please read this thing. In fact, an assignment. Sorry, before you go. Thank you. I just remembered. Please read up, right? Read up. I'm expecting, I put some questions here, up to 4 questions. 5 questions rather. I was just going through these questions and I observed that they are not even related to interest rates, hedging and all those kind of things. But they are things we have treated before, right? They are things we have treated before. So solve them. I will still update this. I will put in questions that relate to the recent topic we are learning, but I might not solve all these ones that I put here. So solve them. I will put new questions, and those are the ones I will attempt. So solve this is on you, right? Solve it. I will be looking forward to your feedback on Sunday. Take care of yourself for the last time. Have a good weekend. Bye.